Something strange happened quietly in the gold market, something that hasn't happened since the late 1970s. And if you understand what that comparison actually means, if you truly understand the gravity of what played out the last time gold entered this zone, you will never look at your retirement portfolio the same way again. Gold is sitting around $4,300 an ounce right now. It already touched an all time high of $5,600 earlier this year. And yet, most Americans are going about their day completely unaware that we are tracking almost perfectly along the path of the most explosive precious metals bull market in modern history, the 1979 setup. Now, I want to be very specific with you here, because this isn't just about price levels. This is about the underlying architecture of a market that has, throughout history, behaved in ways that confound most mainstream analysts, right until a moment it doesn't. And when it doesn't, the move is violent, it is fast, and most people miss it entirely. They either got out too early or they never got in at all. So let's go back to 1979. Let's actually understand what was happening in that world, because the parallels aren't just similar, they're almost disturbingly precise. In 1979, gold started the year sitting quietly in the neighborhood of $220 an ounce. Most investors at that time considered gold kind of a relic. The Nixon administration had ended the gold standard in 1971, and for several years, gold had been bouncing around, occasionally spiking, but nothing that suggested what was about to happen. Financial experts on television were calling gold a speculative instrument for nervous people. The mainstream financial establishment was dismissive. Then, in the spring of 1979, something shifted. The Iranian Revolution had already removed one of the world's largest oil producers from the global market. Inflation was running hot, really hot. The consumer price index was climbing toward levels that most Americans alive today have never experienced. And the United States dollar was under assault. Not metaphorically, actually under assault. Foreign central banks were beginning, quietly and then not so quietly, to question whether the dollar's dominance was something they wanted to continue subsidizing. By mid 1979, gold was pushing toward $350 an ounce. People started paying attention. But the really interesting thing, the thing that most financial commentators miss when they tell the 1979 story, is what happened to sentiment. Even at $350, even at $400, even as gold was making historic moves, the majority of retail investors and even professional money managers were sitting on the sidelines. They thought they'd missed it. They thought the easy money was already made. Then came December 1979. The Soviet Union invaded Afghanistan. Oil prices spiked again. Inflation expectations ratcheted even higher. And gold went parabolic. It moved from roughly $450 in December to $850 by January of 1980, in a matter of weeks. The people who thought they'd missed the move in 1979 were staring at a market that had doubled in 60 days. Now, I need you to sit with that for a moment, because we are looking at a remarkably similar setup today. Think about what drove that 1979 to 1980 explosion. You had geopolitical instability at a level that made the global order feel genuinely uncertain. You had inflation that had been entrenched for years and that central banks were struggling to contain. You had a dollar that was losing credibility as the anchor of the global financial system. You had retail investors and institutional money managers who were collectively underweight gold and precious metals, who had watched the move happen from the sidelines and were increasingly itching to get in. And you had physical supply that simply could not keep up with the demand that was beginning to materialize. Every single one of those conditions is present today. Every single one. Let's start with inflation, because I think the American public has been gaslit on this subject for years. We were told inflation was transitory. Then we were told it was under control. Then we were told it was beaten. And yet anyone who actually goes to a grocery store, anyone who has tried to buy a house in the last several years, anyone who has looked at what their fixed income actually buys compared to what it bought a decade ago, knows that something fundamental has changed. The purchasing power of the dollar has been quietly, systematically destroyed. And gold, which has been used as a store of value across every major civilization for literally 5,000 years, has been responding accordingly. Gold doesn't lie. That's the thing that makes it so compelling and so terrifying at the same time. Gold doesn't care about press conferences. Gold doesn't care about what the Federal Reserve says at its next policy meeting. Gold prices in the reality underneath the narrative. And the reality is that we are in the middle of a dollar debasement cycle that has no clear end in sight. Now, the central banks know this, and this is where the story gets genuinely fascinating, because the behavior of central banks over the last several years has been one of the most underreported financial stories of our time. Central banks around the world have been buying gold at record levels. When you look at what countries like China, Russia, Poland, India, Turkey, and dozens of other nations have been doing with their reserves, you see a consistent and unmistakable pattern. They are moving out of dollar-denominated assets and into physical gold. Not paper gold, not gold futures. Physical, allocated, audited gold that sits in their vaults. Now, why would they do this? Central banks are not speculators. They are not making a bet on the short-term price action of a commodity. When a central bank makes a multi-year, multi-billion-dollar commitment to accumulate gold, they are making a statement about where they believe the global monetary system is heading. They are expressing a fundamental view about the long-term credibility and durability of the current dollar-based financial order. And that view, increasingly, is that the dollar's dominance is in decline. The BRICS expansion has been one of the most significant geopolitical developments in recent memory. You now have a coalition of nations representing a substantial portion of the world's population, its energy production, and its manufacturing capacity that is actively working to build trade infrastructure that bypasses the dollar, oil deals being settled in currencies other than the dollar, bilateral swap agreements, alternative payment systems designed specifically to reduce dependence on the SWIFT network that the United States controls. This is de-dollarization, and it is not a fringe conspiracy theory. It is a documented, publicly discussed policy priority for some of the most powerful governments on the planet, and it is extraordinarily bullish for gold, because when the dollar loses its monopoly on global trade settlement, gold, which has no counterparty risk, which cannot be printed, which cannot be sanctioned, which has been the world's reserve asset for most of human history, becomes the obvious beneficiary. Before I go deeper, I want to mention something quickly. I put together a free guide in the description below. It lays out the savings and protection strategies that a significant number of American retirees are quietly using to protect what they've worked their whole lives to build. If that's relevant to where you are in life, it's worth checking out. Now, let me talk about the mechanics of the gold market itself, because I think this is something that most investors simply don't understand, and it's critical to understanding why gold's price behavior can be so dramatic when moves start to accelerate. There are essentially two gold markets operating simultaneously. There is the paper gold market, the futures contracts traded on exchanges like COMEX in New York, and the London Bullion Market Association's forward market in London. And then there is the physical gold market, actual bars, coins, and allocated accounts where real metal changes hands. The paper market is enormous. The amount of gold traded on paper on any given day dwarfs the actual physical supply of gold that exists above ground. Estimates suggest that for every ounce of physical gold that exists, there are many multiples of that amount represented in paper claims. This system works smoothly as long as everyone plays by the unspoken rules, as long as most paper holders are happy to roll their contracts and never take delivery. But what happens when that confidence breaks down? What happens when a large holder of paper gold decides they actually want the physical metal? What happens when multiple large holders make that decision simultaneously? What happens is a short squeeze in the physical market that can drive prices in ways that fundamentally untethered from anything the paper market models predicted. We have seen hints of this dynamic play out several times in recent years, and the setup for a more significant episode continues to build. The lease rates on gold, essentially the interest rate you pay to borrow physical gold for a period of time, have been showing stress. COMEX registered inventories, which represent the gold actually available for delivery against futures contracts, have been watched very closely by sophisticated observers who understand what those numbers are telling you about the underlying tension in the market. When the physical market starts to assert itself over the paper market, and historically it always does eventually because reality always wins, you get the kind of explosive move that 1979 and 1980 demonstrated. The paper price, which had been held in check by the mechanics of futures trading, suddenly has to catch up to what physical buyers are actually willing to pay. And right now, physical buyers, from central banks to sovereign wealth funds to high net worth individuals in Asia and the Middle East, are showing no sign of backing away. Let's talk about the industrial dimension, because gold is not just a monetary metal. It's not just a store of value. Gold has real, growing industrial applications that are adding structural demand on top of the investment demand that's already building. The semiconductor industry uses gold. Medical technology uses gold. The aerospace sector uses gold. And with the continued expansion of advanced manufacturing, particularly in the technology sector, industrial demand for gold has a secular tailwind that exists completely independently of whatever happens with inflation or central bank policy or geopolitics. You are looking at a metal where the demand story has multiple overlapping drivers, and where new supply coming out of the ground is genuinely constrained by the reality that the world's easiest and richest gold deposits have largely already been found and mined. The gold to silver ratio is something I want to spend a moment on, because if the 1979 analogy plays out in any meaningful way, silver is actually the more dramatic story in price percentage terms. When gold ran in 1979 and 1980, silver ran harder. Silver went from under $5 an ounce to nearly $50 an ounce over that same period. Silver today is sitting around $70 an ounce. It's already had a significant move, and yet the gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is still at levels that historically suggest silver is undervalued relative to gold. In precious metals bull markets, silver tends to lag gold in the early innings and then accelerate dramatically in the later innings. If we are in the middle innings of this cycle, as the 1979 comparison would suggest, the silver story is something that deserves serious attention. Now, let me talk about the institutional picture, because the commercial positioning data coming out of the CFTC, the Commodity Futures Trading Commission, which tracks what large traders are doing in the futures markets, has been showing something very interesting. The smart money, meaning the large institutional traders who have access to information and analytical resources that retail investors don't, has been consistently positioning on the long side of gold, even as prices have moved dramatically higher. This is not the behavior you see at a market top. At market tops, you see institutions distributing their positions to retail buyers who are late to the party. What you're seeing in gold right now is institutions continuing to accumulate, which suggests that the most sophisticated players in the market believe there is substantially more upside ahead. Think about what happened with the hedge fund community in 1979. Paul Tudor Jones, one of the most successful traders in history, has spoken about how the commodity and precious metals markets of that era shaped his entire approach to macroeconomics and trading. The people who understood what was really happening, who understood that the debasement of fiat currencies was a fundamental structural process rather than a temporary aberration, positioned themselves accordingly and generated life-changing returns. The people who waited, who kept waiting for gold to pull back to a reasonable level, who kept looking at the charts and thinking it had already run too far, who kept telling themselves they'd buy on the next dip, watched the move from the sidelines as gold more than tripled in less than 12 months. Here's what's genuinely different today compared to 1979, and I want to be honest about this because it cuts both ways. In 1979, there were essentially two ways for a regular American to own gold. You could buy coins or bars from a dealer and store them yourself. Or, if you were sophisticated enough to navigate the futures market, you could take a position there. That was essentially it. The infrastructure for gold ownership was primitive, expensive, and difficult. Today, the options are dramatically broader. You have ETFs that allow you to own a claim on physical gold through a standard brokerage account. You have digital gold platforms. You have streaming companies and royalty companies that give you leveraged exposure to gold through equity markets. And critically, and this is something I want to talk about specifically for people who are watching this and who are in or near retirement, you have the Gold IRA, which allows you to hold physical gold inside a tax-advantaged retirement account. This is important because one of the great mistakes that many Americans made in the 1970s, even the ones who correctly identified the gold bull market, is that they held their gold in taxable accounts. When the move was over and they sold, they faced substantial capital gains tax on the profits. Today, with the right structure, it is possible to own physical gold inside a retirement account in a way that defers or potentially eliminates that tax burden. If you have $100,000 or more sitting in a retirement account, whether that's a traditional IRA, a 401k, a 403b, or similar, I'd encourage you to take a serious look at whether gold has a role to play in your wealth protection strategy. Not because gold is guaranteed to do what it did in 1979, nothing in markets is guaranteed, but because the risk of not having any exposure to hard assets at this particular moment in monetary history is genuinely significant. And most financial advisors, frankly, are not incentivized to have that conversation with you. The guide in my description covers how gold IRAs work in plain English. No jargon, no pressure, just information. Check it out if that's something you want to understand better. Now, let's talk about what the 1979 setup actually means for where gold could be heading. In 1979, gold's move from its starting point to its eventual peak was roughly 4 to 1. If we use the trajectory of this cycle, accounting for the fact that prices are obviously starting from a much higher nominal base, and accounting for the fact that the dollar itself has depreciated significantly since 1980, the numbers that various analysts are putting on a potential peak for this cycle are extraordinary. We're not talking about a modest further move. We're talking about scenarios where gold tests and potentially breaks levels that would have seemed impossibly speculative just a few years ago. But here's the thing I want you to understand about the 1979 to 1980 parabola, because I think it's the most important psychological lesson of that entire era. The move, when it came fast. The people who were waiting for a pullback to buy in at a better price didn't get that pullback until the move was already essentially over. The people who kept saying, "I'll buy when it consolidates," found that by the time there was meaningful consolidation, the price had already moved so far that the entry point they were waiting for had been permanently left behind. This is not an argument for recklessness. I'm not saying you should ignore risk management or position sizing. I'm saying that in markets driven by the kind of fundamental structural forces that are driving gold right now, currency debasement, geopolitical realignment, institutional repositioning, physical supply constraints, the moves can be sharper and more sustained than even bullish investors expect. The Federal Reserve finds itself in a position that is quite genuinely without precedent in the modern era. It is managing the world's reserve currency at a time when that currency is under unprecedented structural challenge. The national debt trajectory creates a fiscal reality that constrains monetary policy in ways that weren't true in previous cycles. The ability to raise interest rates aggressively, the tool that Paul Volcker used in the early 1980s to ultimately break the back of the inflation that drove gold to its 1980 peak, is far more limited today, given the debt burden that the government carries. This is not an accident. This is the result of decades of policy choices, and the cumulative effect of those choices is now being priced, slowly and then potentially all at once, into the hardest asset on the planet. The geopolitical backdrop adds another layer entirely: the fragmentation of the post-World War II international order, the order that was built around American military and economic dominance, and that anchored the dollar's role as the global reserve currency, is accelerating. Trade disputes, sanctions, shifting alliances, military conflicts in multiple theaters simultaneously. These are not noise. These are signals about the underlying structure of the global system, and they all point in the same direction for gold. When uncertainty is high, when the institutions and arrangements that people have relied on to keep the world functioning in a predictable way are under stress, the asset with 5,000 years of track record as a store of value sees its demand increase every single time, without exception. It happened in the 1930s, it happened in the 1970s, it happened in 2008 and 2009. And it is happening now, at a scale and with a velocity that puts us firmly in the territory of those historic precedents. Let's bring this back to the practical reality for the person watching this video. If you are retired or approaching retirement, you are facing a set of financial challenges that no previous generation of American retirees has faced in quite the same combination. You have potential inflation that erodes the real value of fixed income. You have equity markets that are priced at historically elevated valuations after a long bull run. You have bond markets that are offering yields that, after inflation, may not be providing the real returns that traditional retirement planning models assumed. And you have a dollar whose purchasing power has been on a long, slow decline that shows no sign of reversing. Gold, historically, has been one of the most effective assets for protecting purchasing power over long time horizons. Not for everyone, not as a speculative vehicle, but as part of a diversified strategy specifically designed to preserve what you've built against the forces that are eating away at it right now. The 1979 setup is flashing. The signals are there for those who know how to read them. Central banks are telling you something with their buying patterns. The paper to physical ratio in the gold market is telling you something about underlying stress. The BRICS realignment and the de-dollarization trend are telling you something about the long-term trajectory of dollar hegemony. And the fiscal situation of the United States government, the trajectory of the national debt, the interest expense that is now one of the largest line items in the federal budget, is telling you something about the limits of monetary policy in a world where paper money creation has been the default response to every economic crisis for decades. Gold entered the danger zone. The last time it was here, in 1979, The people who understood what that meant and acted accordingly watched their wealth multiply several times over in a matter of months. The people who waited, who doubted, who told themselves the move was already over, they watched from the sidelines as one of the greatest wealth transfer events in modern monetary history played out without them. History doesn't repeat exactly, but it rhymes. And right now, the rhyme is getting louder. For those of you who made it to the end of this video, and honestly, thank you for that. It means you take this seriously. There is something specific I want to offer you. Anyone who reaches out by mentioning this video when they check out the free guide in the description will qualify for a complimentary, no-obligation, one-on-one educational session with our team. A real conversation, not a sales pitch. An educational consultation designed to help you understand exactly what your options are, what a gold IRA looks like in practice, and whether it makes sense for your specific situation. This is available exclusively to American retirees who have at least $100,000 in any retirement account. The link is in the description. The guide is free. The conversation is free. The information will cost you nothing. What you decide to do with it is entirely up to you. The danger zone is here. The question is what you do about it.